Hi, welcome to Grand Insights. I'm your host, John Feligno, founder of Grand Life Financial. I'm going to share how you can use a strategy called tax loss harvesting to convert investment losses into tax deductions. So let's start with understanding how investments are taxed. Those that are sold within 1 year will be taxed at what's called short-term capital gains rates, which are generally the same as your ordinary income tax rates. Those that are held more than a year are taxed at long-term capital gains rates, which have lower rates. So for those that you sell at a loss, you can offset them with any gains that you realized. Now, what do I mean by realized? Well, that's for those that you have sold, as opposed to those that experienced a gain or a loss, but you've not yet sold. Those would be called unrealized gains or losses. The tax loss harvesting strategy involves converting investment losses into a tax deduction while remaining invested. To do this, you look to sell investments in your non-retirement account that have depreciated to offset gains for investments sold for a profit. You then purchase new investments with the intent of preserving your portfolio's overall balance and expected risk and return levels. Now, there are strict guidelines that must be followed, namely the IRS wash sale rule. This prohibits repurchasing the same or a substantially identical security within 30 days before or after the sale. The term substantially identical does not prohibit you from purchasing investments in the same industry, just not the same company. So you can use this to buy exchange traded funds or mutual funds, for example. Now, if your capital losses exceed your gains, or even if you don't have any gains, you can use these to offset up to $3,000 in non-investment income, and any loss above this can be carried forward to future tax years. If you'd like to learn more or have suggestions for a future topic, please email or call me. Thanks very much for joining.